Victor, so wanted to let you know that I will be recording this session, so please mute your line. And I'm going to go ahead and get us started. So here we go. Can everyone see my screen? Okay, great. I trust that you can see my screen. Can someone confirm?
Yes.
Great. I'll go ahead and get it started. So thank you, everyone. Good evening. My name is Chris Price. I'm the host of the Wealth Mindset and Real Estate Investing Meetup. I'm also the CEO and co-founder of Red Fox Multifamily. And let me give you a little bit of information about both of these. So Wealth Mindset and Real Estate Investing is a meetup that's open to all who are interested in growing generational wealth through passive real estate investing and increasing their financial intelligence. This meetup is for the busy professionals and retirees across various industries. The individuals in the group make a good living and have discretionary income to invest in real estate for its proven wealth building power, but don't have the time or skill sets or network to do it at speed and at scale. So this meetup focuses on helping us all grow our wealth mindset by learning how to build and preserve wealth while developing and maintaining an abundance mindset. This meetup will focus on multifamily real estate investing, as well as other proven ways to build wealth through real estate through passive investments. I'm sure we're going to learn a little bit about that today. And then as it relates to Red Fox Multifamily works with investors who are dissatisfied with the low return from savings accounts and bonds, and investors who are concerned about the volatility of the stock market. Red Fox Multifamily puts discerning investors' capital to work for them by investing in exceptional multifamily properties in the best markets nationwide. The demand for multifamily rental units continues to grow and is driven by both the preference of certain demographics and as well as unfavorable single-family home ownership options. Fox Multifamily is based in White Plains, New York, and we partner with investors for whom the stability of real estate investment appeals, but the stress of property ownership does not. So we give our investors the benefits of real estate investment through syndication, which is, for those who are not familiar, a group investment in a multifamily property in our case. So thank you for allowing me to go through that brief commercial break. What I'm going to ask you to do for those of you who are on the line right now is to please mute your lines when you're not speaking so that we can prevent any background noise from interrupting our guest speaker this evening. And if you would prefer, unless our guest speaker this evening would like, you can hold your questions to the end of the presentation. But of course, if you have something that's burning and you want to get your question answered, go ahead and raise your hand. And I know that our speaker this evening will address it. She is a natural teacher, and I can attest to that firsthand. This presentation is being recorded, and this material does not constitute as an offer or solicitation to purchase securities. And then finally, this is information only and should not be construed as business, financial, or legal advice. So finally, if you want to connect with me, please do reach out with me. Reach out to me. My email is here, and it's chris@redfoxmultifamily.com. And so in terms of the basic flow for this evening, I'm going to introduce our speaker next. She is going to take us through a presentation and help educate us on tax strategies. And we'll have a time for Q&A. And then for those who want to hang back for a minute or two, we can do some virtual networking. So here we go, guys. Let me introduce our speaker for this evening. Our speaker for this evening is Kelly Johnston. Actually, the name of the presentation is Tax Strategies Through Real Estate Investing. Kelly Johnston has a large amount of experience in both the public accounting and private accounting fields. Her background includes a Bachelor in Finance and a Master's of Science in Accounting, with experience in the healthcare industries with critical access hospitals and physician offices, audit, and tax preparation. Her education and experience can add value to new startup organizations, developing businesses, and healthcare entities by creating a strong financial reporting setup and assisting in new financial reports. personally, Kelly loves to spend time with her husband outdoors and riding her horses. And I know, Kelly, you may have to tell us the story about the amount of acres between you and a neighbor, because I think that in this neck of the woods in the Northeast where I live is just completely unheard of. But thank you very much for coming on this evening, and I'm going to stop presenting and hand it over to you so that you can help educate us all this evening.
Awesome. Chris, thank you so much for that amazing introduction. If y'all don't know Chris personally, get to know this man. He has so much fun energy to be around. It really lights me up as, an accountant. I know our topics are not always the most riveting. I mean, when you talk about taxes, people usually run and hide, or you're like, oh God, she's going to put me to sleep kind of thought process. But I do know that Chris helps bring out the energy, and I hope you guys please interrupt me with questions. I do want to have this be a little bit more interactive this evening, just because it is such a chewy, hard topic if we're not careful. So, as Chris mentioned, my bio is always hard to write. I'm going to share that right now. And I was also really struggling a little bit with what to present tonight, because real estate as a tax investment strategy and a wealth building strategy, there are so many ways that I could go with this. So I chose some of the major overarching themes as it relates to a real estate investor and where most common mishaps happen at the beginning, in hopes that it will really help you guys not mimic some of the mistakes that I've seen. But also at the same time, I want to talk about some really cool available strategies for us, especially because if you house somebody and you employ somebody, there's a lot of opportunities for you as it relates to tax deductions. As Chris mentioned, I do live in the middle of darn near nowhere. I live on a really large ranch. My closest neighbor is about 100 acres away. I own 35.5 acre ranch, but I also own investment real estate because I can't practice what I preach, or can't not practice what I preach. And I feel like real estate is a great way to diversify your portfolio. And of course, as a tax accountant, I can't not have a killer tax strategy myself, right? Like, what kind of a tax accountant would I be if I didn't leverage this? The other piece I do want to mention is I get really excited about finance and taxes. And as a result, I tend to talk faster. So if at any point in time you need me to say, hey, slow the horse down, we need to go back and look at it, please interrupt me and tell me. Because as Chris knows, he's experienced some of my conversations, I will just get on a roll if I'm not careful. I did prepare some slides to keep me on a little bit of topic tonight, because there's so much I don't want to miss it. But again, it's meant as a guideline, not as a hard, rigid zone. So I'm going to share my screen here. So give me just a second.
Absolutely, and as you do that, I missed the most important part, and everyone should know that Kelly, we have the great pleasure, Allison and I, of having Kelly as our personal CPA and an accountant, and that has been just a wonderful thing. And transitioning and working with Kelly over the past few years has literally saved us a lot of money, and has gotten us on a track, and it's beyond the savings and the tax strategies and putting us in the best position to be savvy investors, but it's the education and the care that Kelly brings along the journey with us here to help meet us where we're at and then help us grow with her. And so it's I would just say enjoy this evening, and thank you very much, Kelly, for all that you do for us.
Oh, well, thanks, Chris. I appreciate that. I did not pay him to say that. So just full disclosure. All right. So on that note, Chris already addressed this, but I do have to always start with this legal disclaimer, because if not, my attorney would be sorely disappointed in me. But I am not giving anybody specific accounting, business, or tax advice. This is for educational purposes only. My goal is to help, give you education and help you make smart decisions. What I hope it does is this information sparks enough questions for you to go to your current CPA or reach out to a CPA if you don't have one and really start diving in. And here's the thing about CPAs, and I'm going to knock on my profession. So if any CPAs are listening to this, I love you all dearly. But I also have to say that if your CPA can't answer questions as it relates to the topics tonight, it is an opportunity to revisit your CPA situation. And I say this with the utmost respect, because people come to me and ask questions in a specific industry. And if I don't know it, I have the responsibility to say, I don't know, but I can find you a CPA that does. And so I really hope that you can dive into the questions from that perspective. I'm not going to put this in presentation mode because I'm going to flip back and forth to my little whiteboard. So just know it's not as clean normally, but I'm not about clean here. I'm about trying to get you guys the information you need. So the first thing is I want to talk about real estate as this long-term wealth strategy and taxes paired with long-term wealth. Because when everybody hears taxes, most people don't think of the word wealth, right? Like they think of this is an expense. It sucks to pay them. Some states are more expensive than others. Like I could go on and on. But to me, a good wealth building strategy is a diversified portfolio in so many aspects, meaning taxes is part of that portfolio. I always joke with my business owners that are starting a business that if you don't take the time to plan for taxes as an expense and or mitigate taxes as an expense, you're doing just as much as a disservice versus if you were to make a decision to hire or fire employees. If you don't think of taxes as if it's a salary and wage expense or even a large maintenance expense in the case of an investment property, you're missing the whole point. Because, and I'll preach this until the day I die, but the tax code that is allowed for those that have high wealth in our United States is the same tax code available to you and I. And what happens is oftentimes we don't look at it. We don't look at taxes as part of the bigger picture. We only look at taxes as it relates to, something, a year-end function. I always joke and call it the shoebox effect. Do y'all know what I'm talking about with the shoebox effect? No? Okay, I see head shaking now. Okay, so my favorite is you save all your receipts for the year, you shove them all in a shoebox, and you show up at your accountant's office on April 13th with the shoebox and you say, I made money, find a way to make it disappear, here's my receipts, right? And my office used to smell like a shoebox, and I joke about it, but it's actually a hard reality. And to me, if you're not looking at taxes and the strategy consistently throughout the year, especially after you buy your first investment, the first rental property, okay, maybe, but like when you start really getting into investing and entity structures and all that kind of stuff, you will leave so much money on the table with those front end errors and structure errors than if you would have just taken the time to make the investment up front. I know accountants are expensive, attorneys are expensive. I mean, shoot, consultants are expensive. But there are some areas to where if you utilize that expense appropriately, it becomes a return on investment. And that's how I see anything as it relates to the educational aspect. So I'm so grateful y'all are plugged into this tonight. But I also look at it as like your CPA and your legal counsel. I mean, don't get me wrong, my attorney charges a good pretty penny, but that is one check I will write and not even bat an eye at because they save me money in the long run. And that's the job of an accountant as it relates to taxes. I also feel like the business model of real estate investing is something that's also oftentimes misunderstood. So I'm going to start our conversations tonight off on the tangent of entity structuring and types of income first. And then we're going to get into some of the tax saving strategies as it relates to real estate. And I'm going to run out of slides because I'm more of a demonstrative person. So I'm going to draw out things because I hope you have scrap piece of paper to do the same exercise with me because I want you to leave here knowing, do you have the right entity type set up? Have you talked to your legal counsel as it relates to that entity? Because oftentimes attorneys are only looking at it from an asset protection strategy and not from a taxation strategy. And the two have to work together. And so that is a part of it. I actually think I took the slide out and I probably should have left it in. I joke that every real estate investor that is purchasing or even buying into a syndication or anything to that effect needs to have an invisible board of directors that they constantly are reaching out to. And your invisible board of directors should include an accountant. And an accountant can be more than one person. You can have a bookkeeper and a CPA, or they can be one in the same firm. You just want to make sure that you are keeping accurate records and getting the tax advice you need. You should have legal counsel. You should have a killer attorney. If you don't have an attorney resource, I'm sure Chris could hook you up. If not, I have some referrals too on that front. But legal is so crucial. You should have a really great banking relationship. COVID was the best case study I could ever ask for, and I hate to say it that way, as it relates to banking relationships, because a lot of my clients didn't understand what I meant by that request of having that relationship with a banker. But when COVID hit and all of these different programs or incentives came out, such as PPP, ERC, the loan moratorium and things like that, if you didn't have a human being you could talk to, it was really hard to take advantage of those programs. And so having that banking relationship is super crucial. I also feel like you should have somebody else in your back pocket, such as an insurance advisor, as well as an investment advisor. And so the fact that you're part of this group, investment advisor can mean so many different things. Like my husband is more of a paper asset person. I'm more of a real estate asset person. We have both of those advisors in our court. I have real estate people I call upon. He has a financial advisor. And so again, you want to surround yourself with this invisible board of directors to really help you out. And the cool part about that is not on this slide, is that can be a tax deduction. So let me let that sink in a second. Your invisible board of directors can be a tax deduction, meaning if you set up an appointments with your invisible board of directors and they charge you and you go to a meal and stuff, you can write it off. So ultimately you're writing off all this this education, right? And the meal that you have with them. And a lot of people don't look at that as a substantial reason to have a business meeting. But if you are an active real estate investor and you have an active business, and I'm going to talk about those keywords here in a second, those types of items become a deduction. If in terms of like tax preparation and strategy, those costs are deductible, but there's an allocation component if you're just a sole proprietor owning your real estate. But again, a lot of people don't look at it that way. And so if you're already paying for the expense, why not make it a tax deduction on that front, right? It's not a matter of if it's deductible, it's how do I have to behave in order to make these deductions deductible for me on that front. So with that chewy introduction, we're going to dive right into this thing called entity structures. I'm going to stop sharing my screen for a second because I need to see some human faces. If you're not showing your face and you're willing to do so, please do. Again, the interactive part of this conversation. If not, come off mute. This is a great opportunity. I want to know here, what is an entity structure? Who knows what that is? Chris, you're barred from answering yet.
Yes, I am. I'll let someone else answer.
Okay, cool. Nobody's going to take a stab at this?
Or you can type it in if you prefer, if you want to do that.
Yes, I won't hold anything against you if you're wrong. I promise I don't bite too hard. All right, well, I'm getting no takers. This is kind of sad, but that's all right. I won't hold any judgment against y'all. Chris, do you want to take a stab at it? Oh, Eric
we
came
got
on
somebody.
mute. Go, Eric.
Is that in reference to the legality of the business, the way it's structured, like S Corp, C Corp, that kind of stuff?
Yes, sir. Thank you. Thank you. See, it's not that bad. It's all good. All right. Thank you, Eric, for diving into that. So let's talk about these entity structures. I'm going to share my screen again, and we're going to go into an awesome Word document. And I ask that as much as I like to think of myself as an artist, I'm a terrible artist. So don't hold my drawing skills against me. But can you guys tell me what kind of entity structures are available out there? Eric, you rattled off some. Do you want to share those again?
S Corp, C Corp, LLC, sole proprietor, charitable, nonprofit.
Any others?
I'm sure there's a lot that I don't know.
No, this is great.
If you're in the medical field, there's a PLLC as well.
Yes.
And then I think you could be like a combo of some depending on your tax ID, right?
Yes, sir. There's one more big one that's missing. Chris, you can jump in if you want. I'll give you permission to speak.
Let's go with we said C Corp already.
S Corp, sole proprietorship, LLC, PLLC, NP. We're missing one big one that's plays in real estate.
Oh my God. I'm drawing a blank.
Starts with a P.
Partnership.
Thank you, Jesse.
Yes.
Partnership. Awesome.
Yes.
All right. Perfect. So I want to talk about these, and I drew this way specifically for a reason, because this is where real estate could go really wrong, in my opinion. And why I wanted to start here tonight was because I'm trying to undo some issues that have happened in the past as it relates to real estate, and entity structure matters. Okay, and every state is slightly different, so you want to be very specific to your state rules and where the real estate holdings are. So I want to disclaimer that real quickly, but I do want to go through these. A sole proprietorship is somebody that's by themselves, meaning it's just them. They own either a business or some sort of entity that is doing active income, right? If you are an ordinary business as a sole proprietor, a lot of people call this the Schedule C business, you're usually going to be subject to that 15.3% self-employment tax. And we're going to come back to that number as it relates to real estate here in a little bit. So you're subject to self-employment tax. You also are the only person. It's just you. So it's just one cute little human being by themselves. If you die, it dies. So it ends with you. It's the end all be all. And the hard part about this sole proprietorship is that it's usually tied to your social security number. So right now we're in what we call 1099 season. I'm sure you've heard of that form number. 1099s are produced during the month of January and distributed by January 31st and or a couple days after as the mail happens to work. And so oftentimes if you're a sole proprietor and you do non-employee compensation or contract work, you are functioning in this area. This area is actually one of the highest tax brackets, though, because you are subject to ordinary tax rates. And I'm going to talk about what that means here in English here in a second. But what kills me is this additional 15.3% self-employment tax. So we're going to talk about real estate and how it plays into this, because a lot of people don't think of it from that perspective. A partnership is just like a sole proprietorship. It's the same thing as this, but times more than one. So I'm going to say times two just for fun. If you're an active partnership, active trader business, you are also subject to this SE tax, self-employment tax. But what I like about a partnership is it automatically separates it from your personal tax return. From this point on, you file separate tax returns for these different entity types, okay? And so when we talk about taxes and we talk about audits, and I know like there was this big to-do about the IRS hiring all these new agents and whatnot, the more you get things off of your personal tax returns and personal schedules, the less likely there is to be an audit as it relates to that particular type of form, purely because it's based upon the number of forms you file within your personal tax return. The other thing that's also nice about having it be in its own entity is it's not in your social security number, but rather in its own EIN or employer identification number. And it's a lot easier to substantiate to a lender or a bank that it's its own separate entity and it's not tied to you. I don't know if any of you have ever done this before, but if you're a self-employed individual or you only have assets affiliated with you, to get a loan and to leverage debt in a real estate investment strategy gets really complicated because they want everything as it relates to your personal household. But when you start to separate into the other entity types, it becomes a little bit clearer to the bank or lender and or any investment, whether you're looking at venture capital or whatever opportunity zones and whatnot, it becomes easier for them to see these potential items as separate entities and a little less dependent upon you as the individual. In a partnership, what I also like about it is it can be active trader business, meaning it's subject to that self-employment tax. It's an ordinary business. You're putting time and effort in order to earn the income, or it could be a holding for a passive investment. So for an example, if Chris and his wife own a real estate investment and it's not in their personal names and it's in a partnership, it instantly makes it a partnership, pulls it off their personal return, and it opens up the opportunity for it to be separate. An S Corp or S corporation is a really great entity strategy to move you off the sole proprietorship as an active trader business and eliminate self-employment tax. So there's no self-employment tax under an S Corp, okay, which is super awesome. So if you're increasingly producing a profit in a normal business, and I say normal, not real estate investing, but I'm going to talk about that because there's a giant caveat coming up to that. But it's say you are, as a real estate investor, your real estate holdings portfolio as it relates to passive income, you're not going to play that in an S Corp strategy. S corporations would be somebody that's like a real estate agent, meaning you do this as an active trader business and you're not holding the actual assets. It's great because then you're not subject to self-employment tax. The hard part about an S Corp, though, is you have to have this thing called payroll. Okay? And many of you are like, well, wait a second, payroll comes with payroll taxes. Yes, and the payroll does not necessarily have to be equal to the bottom line. So there's a strategy around that piece. Why I put LLC and PLLC up here is because you can be an LLC and that doesn't tell me anything about your taxes. Nothing. LLC, PLLC, LLP, like I can go on and on and on the acronyms, but we'll just say LLC for the sake of the simplicity here. LLC is a legal entity structure used for asset protection and registered at the state level. The IRS recognizes it as a disregarded entity. However, you have to tell the IRS, am I taxed as a sole proprietor, taxed as a partnership, or taxed as an S Corp? Naturally, if you're an LLC and you have more than one member, you become a partnership. If you're an LLC and you only have one member, you naturally become a sole proprietor. You have to tell the IRS if you're an LLC and you want to become an S Corp, you have to make what we call an S Corp election. This is important because real estate, if you are investing and you purchase real estate under one of these entities without considering the umbrella up above, if you go to transfer it from yourself to an LLC or an S Corp out of any of these entity types, you actually can create tax problems and not even realize you do it. So titling of a real estate investment as it relates to this is crucial. This is why I love that you have that invisible board of directors conversation. I have a bunch of clients that are real estate investors and construction agents paired with that, real estate agents paired with that. And what will oftentimes happen is the lawyer will say, okay, well, we need to move that asset into a trust in order to protect your assets. That's all fine, but let's talk about the tax ramifications of doing that, because there's a proper way of doing that to protect it and also not get nailed to the wall with a huge tax bill at the end of the year, right? And so that is where this entity structure thing can go really awry. Over here is the C Corp thing, and the C Corp thing is its own beast because everything on this side of that dotted line is flowing through to you as the owners on your personal tax return, meaning an S Corp, a partnership, and a sole proprietorship does not pay federal income tax. And I'm being very specific here when I say federal income tax, because some states have decided through their franchise tax boards that some of these entities are subject to tax. A great example is California. Sorry if there's any Californians listening on this call. Colorado is really close to following in your footsteps, so I guess we're not far behind you. But like S corporations and LLCs are subject to tax at those levels, as well as flow through tax. So you have to be very clear about your state rules on that front. Jesse, I saw your question come through. I'll look at it here in just a second. I'll come back to it. The other piece, though, that's really important is this C Corp side. C Corps don't flow through to any person. But with a C Corp, there's a really clear purpose. So back in the day, there's this gentleman by the name of Dr. Art Laffer. He wrote the tax bill for Ronald Reagan, and they made C Corps look really marketable during that period of time. And so C Corps had a really low tax rate. And with a C Corp, they're not owned by any one person. They're owned by shareholders. They have their own tax. But then after the Reagan tax bill passed, a couple of years later, legislation came out by other administration raising the rates of a C Corp's tax. Then came the 2017 Tax Cuts and Jobs Act. And what's interesting about that act is that it was written by Dr. Art Laffer as well. So the same guy that wrote Reagan's tax bill wrote the Trump tax bill, as they call it. And so C Corps dropped again in tax. And C Corps are great for real estate investors because these can become management companies and or PEO models and things like that. So there's a place for a C Corp. But what I want to caution people on, and what I see people usually make a mistake on, is putting real estate in a C Corp, because it can create some tax issues as it relates to selling said real estate. It'll create additional tax. And then, of course, you have the nonprofit piece. And I love my nonprofits. I actually serve quite a few of them, both on boards as well as just as an accountant. We do a lot of nonprofit accounting, but there's a place for nonprofits as well, right? And so again, the whole goal is, as you continue to increase in your wealth building strategy, you're going to want to know how to leverage each of these entity types to support you in your investment. I'm going to pause for a second because I think I know I had a chat question. I think it's relevant to this discussion. So which entity do you suggest investors should create to invest in a syndication? Ooh, good question. So let's back that question up a little bit further. What entity type is a syndication? Does anybody know? Usually, I'm going to say usually. All right, I don't hear an answer. So a syndication, which is a really great investment strategy, is usually structured as a partnership. You have general partners and limited partners, right? So you're usually playing in this space. Now, that syndication might be an LLC taxed as, or an LLP, depending on the state that the assets are held, because again, each state treats that a little bit differently. But if you are investing in the syndication, it comes back to who owns the interest. Now, if you are a passive holder, it's okay for it to be you or another LLC holding that interest. But if it's an active partnership syndication, meaning short-term real estate treated more on the doing substantial services like a hotel-based VRBO, Airbnb model, then you might want to look at you having your LLC hold interest that's taxed as an S corp to eliminate the subject to self-employment tax rules. That was a lot of gibberish that I just said. So let me show you. Again, I'd speak accountant, so I drew a bunch of diagrams to help me explain this because I knew this question was coming. So this is you as the human being. This is a lot prettier version than my attempt at drawing, but I'm still going to draw on this mess here. This here is a partnership. So this is your partnership syndication, and you hold interest in this partnership. But say this partnership decides to do short-term rentals, and they offer substantial services. Does everybody know what substantial services is per the IRS? Or is that a new topic?
I think that's a new topic.
Boom. All right. Well, see, this is what I said about the real estate. I can go down rabbit holes all day long. All right. So substantial services. If you own a short-term rental like an Airbnb, VRBO, and you offer more services than just turning it over to the next user, meaning you offer concierge coffee and breakfast, or you give them, daily like turn down service and laundry service and whatnot, you are playing with what we call substantial services rules, and you ultimately turn this investment into a hotel type status. That's the best way to put it in English, meaning that a hotel is treated like an ordinary business. And when I'm going to draw a line here, because this is my passive bucket and this is my active bucket. By getting substantial services, you actually make this active, which this is where that 15.3% additional tax comes into play. So if it's substantial services, and this is a partnership syndication in a short-term rental conglomerate, meaning multi-unit, short-term rental, whatever that might be, you would want to have something to buffer this 15%. If it's not, let me just erase this all before I go too far. If it's not, you can
Kelly,
leave it all.
By buffer, do you mean like a different entity?
Yeah, we're going to talk about that here in just a second. Yeah, we'll talk about I love entity structuring if you don't know that yet. So if it's just a basic syndication, it's okay for you to own it directly and personally. Now, each state might want you to have like a living trust in here for some asset protection, meaning if you're in Commonwealth states, meaning you make an investment, but your spouse gets equal investment, or you have issues as it relates to estate planning in your state. I can go on a list of states on that front. Like New York is one that is actually one that's a hot button. California, Oregon, Pennsylvania. These are some of the harder states. You definitely want to have some sort of like living trust that tells you where those assets go if something were to happen to you, so you protect them. But it's okay to hold the interest essentially in your personal name. But let's say it is a short-term rental. And I want to go back to this. Say it is a short-term rental and it's active income. You would actually want an S corporation in between, because the S corporation, as I've mentioned in my prior drawing, my really awesome drawing, remember, no SE tax, right? And so if you run your active trader business through an S corporation, you reduce or eliminate the potential for that SE tax. That makes sense? We got really deep really quick on this call, so I'll make sure we're good.
I don't see any other questions, but I think it's good to clarify between short-term rentals and investing passively into syndications, because again, with this audience and folks wanting to diversify into different types of real estate assets, there are so many, as you mentioned before. Of course, short-term rentals have become, they are certainly a great asset class, but people should understand how to appropriately structure them to ensure that they're invested in a way that gives them the most favorable tax advantages.
Very much so. And here's the deal about real estate and entity types, which is why I wanted to start the conversation with entity types. I'm also going to go into the types of taxable income. And Chris, am I okay to go a little bit over on time this evening? If people want to jump off, they can.
Yes.
Okay, cool. Because I don't know how I'm going to do this all in an hour, and I think this is important information for you guys to hear. So the one thing that I want to real quickly talk about, though, before I go too far down the road of how you can where each entity type fits the real estate investment types, because I'm going to go through when to be a partnership, when to be an S corp, when to be a C with real estate. I think it's important. But here's the thing that really matters the most is that initial setting up of everything as it relates to these entity types. Because oftentimes what happens is people will come to me after they already own real estate in a C corp or an S corp, and then they say, how do I get out of this? Because now I can't sell it. Because when you put real estate in an S corp or a C corp, unless you have a really darn good reason to do so, and there are some, but it's very rare, when you go to take the real estate out, because real estate is either buy until you die, or you better have a really cool 1031 or exit opportunity zone type strategy to get out of it. When you go to get rid of it out of an S corp or a C corp, you actually create double taxation. So you're going to create a gain tax as it relates to the distribution out of the S corp, or you're going to create a dividend type tax out of the C corp, which is why people often say C corps are double taxed. Is every money that every dollar you put that comes out of a C corp is taxed twice. It's taxed either at the bottom line of the entity level or the distribution level as you get money out of a C corp. So there's a really strategic reason to utilize those entities, but you want to make sure your real estate holdings are not necessarily sitting in them. And I say that very cautiously, knowing that I'm not an attorney and there are certain reasons around it where you want to do some planning, but as a general statement, most real estate sits in this partnership individual holding level with asset protection through like an LLC and or a living trust. And then the S corps and C corps are used to manage those assets and or manage the properties themselves. And I'll talk about what that means here in a second. Any questions before I talk about the different types of income as it relates to these before I go into what real estate goes where? Is this valuable so far? If I can get a thumbs up, you doing okay? I don't want to bore you. Victor says thumbs up. Allison says thumbs up. All right, I'm not boring people. That's all that matters. Okay, so I want to, we'll talk about payroll too, Jesse. Thank you, because I'm going to talk about that as to why it matters. I am going to try to not screw this up. See if I can. Yes, we're going to do that. All right. See, I forgot my iPad today. So here we go. Real quickly, there's 3 different types of income as it relates to IRS rules. Okay, there's 3 buckets of income. There's this active and ordinary, there's passive, and then there's charitable or non-taxable income. Okay, 3 types of income. What is our goal in life, especially this group of humans, and I can say that to this group of humans because y'all are real estate investors, or at least you're going to go into that route. Our goal in life in this group is to get as much money towards this direction of the scale as possible as it relates to taxes, right? Because with a proper tax saving strategy, you can find more ways to invest it, house more humans. Like there is a charitable component to what you guys are doing as real estate investors. So many people look and frown upon like the wealthy and the wealth preservation because money has become such a taboo conversation, but you're housing human beings, right? Like you should get an incentive for being able to do as such. So the goal is as you continue to do those types of functions, you can take advantages of the passive and non-taxable income. Active and ordinary takes time and effort to earn. So this is where your W-2 wages sit. This is where like a general business, so like my accounting firm sits in this category, sits here. Anything that takes both time and effort to do is active and ordinary. This is your normal standard tax bracket. So everything from your 10% all the way up to your 30%, 2% tax bracket, that is what your tax is for this bucket here, right? And so most Americans, I don't know if any of y'all are familiar with Rich Dad Poor Dad, but it's one of my favorite books of all time. I read it when I was 15 and have been living by it ever since. You have your employee, self-employed. I might have the quadrants in a little bit wrong, but don't judge me too harshly. But the whole thing is these two are here. And that's what he's constantly saying about in that book about you spending more money on tax. You're not giving us as accountants anything to work with tax code wise to help you save money. Okay. But when you move into the passive bucket, these rates are 15 and 20%, 0, 15, and 20% respectively, depending on how much other active income you have with it. So if you're in the highest tax bracket, and I'm going to pick on California. Well, actually, I'll pick on Colorado. We'll pick on Colorado since I'm from there. California has a really high tax rate, which is where I was going to go. But I'll stop picking on that state for right now because we all like the beaches of California, so it's okay. So with Colorado, if you're not in the passive space, you're paying 32% plus 4.55% plus 15.3% self-employment. You're giving them around 70% of your income away in tax. And last time I checked, I'm a way better investment of my money than my local government. And please, if there's a government official on this call, I apologize to offend you. However, I'm going to tell you right now, I have a better way of spending that and keeping that in my own community and household than most of them do, right? So my goal is to shift my income investment to this passive bucket. This is where like a basic rental property sits, okay? So say I own a single family home, even a multifamily unit. I don't actively work or trade in that business. I'm only spending time on this puppy because I just hold the real estate. Then that's the passive income that where I'm generating. And where this percentage comes into play is on the gains of that sale, as well as if you were to sell it, as well as the income is taxed at a little bit of a lower rate. Over here in the nonprofit charitable space, this is where charitable remainder trusts, there's REITs, there's a whole bunch of other world over here that can play in this space as it relates to real estate investing. But non-taxable, it's a little bit harder to play and explain in a 1-hour overview of tax investing, but there's a whole other game over here is what I'm going to try to get at. You can do some self-directed strategies in this space as well. Maybe Chris will offer to have me come back and I can go down one of those rabbit holes one of these evenings. But the whole thing is, as you move this way, you can save money on tax. Chris, did you have something you wanted to add?
No, I was just gonna say yes, and you did get the cash flow quadrants right on.
Okay, cool.
You know, just in terms of that, which is the follow-up book to Rich Dad Poor Dad, which is one of my favorites, which is the cash flow quadrant. So pick that one up or read it, listen to it. You know, go into it because it will further explain what Kelly is talking about. I'm here just to kind of to break it down. But Kelly, you're doing awesome. Keep it going. I think this is really good.
Perfect. So now I want to go back to my ugly diagram that I started to draw here. Real quickly erase all my marks, but I'm going to leave this one here. So everything on this side of the line is passive. Everything on this side of the line is active. Okay. So if I work a W-2 job, I get paid active income and it's taxed at the higher active rate. If I own a rental real estate, this is just a rental property, it's in the passive income state or passive bucket. But now if I invest in like a partnership syndication, say I want to go in because maybe I don't know what to look for in a real estate property. And that's okay. Like that's the cool part about real estate, the real estate group of people. And this is why I think Chris is like so much fun to hang out with and Allie, purely because we all think slightly differently. We're willing to be humble and say, I don't know, and get the education we need, which is why I like the syndications and that whole process and a lot of the groups, because they offer ways of you to get involved in real estate without having to go out and buy a house right out of the gate, right? Now, some syndications require you to become an accredited investor and all that fun stuff, and that's another conversation for another day. But at the same time, it's a good way of starting to kind of diversify your portfolio on that front. So if you invest in a syndication, depending on your estate or your strategy, you might be able to hold the interest in that syndication directly, or you might put an LLC in between here just to have another layer of protection, because you are at risk as it relates to that partnership. Partnership is one of the larger, more autonomous entity structure types as it relates to the tax code. It actually has the most legislation, most tax court cases, because it's a little, I hate to use the word gray area in tax because people misunderstand what I mean by that, but there's just a lot more ways to structure things in a partnership than you can in a corporation, for lack of better words. So an LLC can be a great asset protection strategy. The other thing is with, depending on your state, if it's worth it being an LLC or a trust. So you're going to want to talk about your state rules. But if you are in a syndicate and you're a minority partner and you're not actively trading in it, then it's okay to be either held in your name or the LLC. You could run all of your real estate through an LLC then to you as an opportunity as well, to treat it like a holding company. I have a lot of clients. I have a client that's coming to the top of my mind right now that I call him the entity collector, because every time I talk to him, he started a new entity. And he's got 98 of them right now. And what we've done is we've consolidated his entities and created a holding company that holds, each holding company holds different things. But here's the thing about LLCs and structuring. If Joe rents this house and he trips and falls, and you have 2 other houses in here, your other 2 houses have the potential to being exposed as it relates to legal ramifications for you having to pay whatever hospital bills or whatever. He could sue you and essentially get the 2 others. So you want to make sure you have enough LLCs holding these properties, or LLPs, or whatever your structure is, to keep assets protected. What I like to do, and when I work with attorneys, and your accountant and attorney should be working together on this strategy. Like, it is crucial that they talk to each other, because oftentimes you'll want to find similarities between the properties and have them in the same company. So in that particular client's case, I have an LLC holding his commercial property. I have an LLC holding his vacant land. I have an LLC holding his residential properties. I have an LLC holding all of his multi-unit properties. So yeah, he has like 4 LLCs, but at least they're like kind assets in that LLC structure. Okay. If you are in a short-term rental space, your short-term rental, whether it's a partnership syndication or not, has the potential of moving over to this active income. Now, there's a benefit to this, because I mentioned the downfalls right now as it relates to the 15.3% self-employment tax. However, how many of you on this call have heard of the term depreciation? Oh yeah, this is real estate's best friend. It's my favorite. Now, for you real estatees out there that don't know what depreciation is, depreciation allows for you to get essentially reimbursed for the purchase price of an asset over a period of time. And the designated timeline is dictated by IRS tax code. And for an example, I buy a refrigerator. The IRS says that refrigerator should last 7 years, and that's how long it'll take to recoup the cost. Now, depreciation comes in 3 different forms in tax world. There's makers, or double declining balance, and it means you get a lot the first year, a little less the second year, a little less the third, so on and so forth. There's straight line depreciation, which means it's the same every single year. Actually, there's 4 types, I lied to you. Then there's the bonus depreciation, which is what we love as real estate, which means you can write off 100%, 50%, or 80%. I'll talk about those thresholds here in a second, the first year. And or there's Section 179 depreciation, which references Section 179 of the tax code, and you can take 100% of the depreciation up to a certain dollar amount. And what's nice about that is, as it relates to real estate should always have cash flow, right? Like, if you are a real smart real estate investor, you're not going to go buy a property that's not going to cash flow, meaning you're not going to bring in more rent than the mortgage or cost of that property is, okay, in its simplest form. However, it should be cash flow positive, tax negative, because of this thing called depreciation. Okay. And the cool part is, if you move it into this active bucket, because you're a short-term rental, you do active trade or business, or there's this thing called real estate professional status, which I'm going to talk about, the loss should offset your active income or your W-2 income, making your tax bracket go down, which is why real estate people save so much money on tax, right? I love it or hate it. I'm going to probably put my foot in my mouth, but love it or hate it, like Donald Trump, Jeff Bezos, Joe Biden, I'm going to name them all because I've seen all their tax stuff. They all stay super wealthy and don't pay tax using this strategy. Okay? They all do. I mean, the Clinton presidency and the Biden presidency uses the charitable section that I was talking about. Trump chose to use the real estate. Bezos uses real estate. All of them use the same this tax code. Okay, but the only way to get real estate from this side of the field over to this side of the field is either short-term rental or this thing called real estate professional status. I'm going to pause for a second because I feel like I'm giving you all the fire hose version of tax strategy because there's so much here. I want to see if there's questions. I know Jesse has a question about payroll, and we're going to talk about that here in a second. But is there any more questions?
Yeah, come off mute if you have a question. I think one of the things as people consider coming off of mute that reminds me of this conversation, Kelly, is just you stated at the beginning, the tax code is not only written for Bezos and Trump and the Clintons and Bidens, and I read an article this morning about Bill Gates and farmland and the hundreds of thousands of acres that he owns and all the things there that come with that. Is that same tax code that they utilize to legally reduce or eliminate their taxes is the same tax code that's available to all of us. And I think, as you're dropping knowledge on people here, I think this, just like you said, it opens their minds to then help to understand, okay, what are the things that I need to be doing in order to put myself and my family in the most advantageous situation.
So true. And I can't say that enough because this is why I love working with a variety of clients, because every day I work through their tax strategy, I come up with more ideas as it relates to saving tax dollars. And so to me, it's a matter of you have to invest in the things that are workable. So I want to be very clear about that, because if you go to a tax accountant and have a W-2 on one rental property, it's really hard for us to do a lot with. But as you start to invest and you start to look at strategy, that's when it becomes you start opening up doors, right? Because depreciation will wear out over time. Like if you 100% write off a property the first year, well, then you don't have the next year you're going to make more money. So you got to keep buying, or you have to have some sort of follow through strategy. Because taxes are a short-term and a long-term game. And a lot of people only look at it from a current year investment perspective, but it's no different than investing in real estate or stocks. It's a long-term play, right? So you have to have tax strategy today, as well as make decisions today that won't hurt you tomorrow. If you don't mind, I'm going to go down the road of depreciation a little bit here, because it did change recently in the last 25 days of our lives. So I think it's important to know. Depreciation, I mentioned this word called bonus depreciation. So if you listen to any cool podcasts, and I'm sure Chris could hook you up with a list. I have a run-in list of podcasts every day. I find new ones I listen to. But if you listen to them, they talk a lot about bonus depreciation. And in real estate, we can't just write off a house, unfortunately. Like when you go, if you own a business, I'll pick on my own company, my accounting firm. When I go out and buy a really nice computer setup for one of my employees, I drop about $3,700 on it, because we go all out, because I live and die by my computers, right? That's what accountants do. In my world, in the accounting sector, I can just write that all off the first year through bonus depreciation. Like I get 100% of that. Let's take and flip this on a head though, and I go out and buy a real estate property. I go buy a residential rental. I can't write off that residential rental the whole first year I buy it. So I can't just instantly write it off and offset it against other income. The reason being is real estate, residential and commercial, is required to be depreciated on straight line basis. However, inside of your real estate, you might have things, cabinets, carpets, windows, window coverings, appliances. If you remember, I said refrigerator is 7 years, not residential rental. Residential rental is a heck of a lot longer than that, 27.5 years. So if you want, last time I checked, most refrigerators nowadays anyway, the old ones maybe, but the new ones don't last 27.5 years. You're lucky if they last, I don't know, the full 7 that the IRS says they do. But what you can do is you can segregate out the individual components of your real estate and depreciate those faster because last time I checked, you're going to be replacing that carpet a lot sooner than that 27.5 years. Recoup the cost up front, so then you have the money from tax savings when the carpet wears out to actually replace it. That is the intention of bonus depreciation. And in 2021 and older, from the 2017 Tax Cuts and Jobs Act, so from September, I think it was 18th of 2017 to December 31st of 2022, bonus depreciation was 100%, meaning you could 100% deduct the depreciation on carpet, the cabinets, the appliances, and whatnot. Starting in 2023, bonus depreciation dropped to 80%. Okay, so 80% of that can be deducted. Start going in 2024, it'll drop to 50%. What I like, and the reason this is important to know, is bonus is a killer tax strategy, because bonus, if it's a depreciable, it could create what we call losses, and you can actually use those losses. The other depreciation types, such as makers and 179, can't go below negative. So just because you can find a way to deduct depreciation more than 100% or more than 80% or 50% using Section 179 per se, you can't use those losses to offset this business's income or your W-2 income if that's how you're going to play. And so that's why depreciation is so important. And so that's, we just want to be aware of that. And that's part of the tax strategy. It's phasing out, again, unfortunately, my world in tax is highly linked to politics, whether we love it or hate it. So that could change with the next election cycle. I don't know. And so we just need to keep tabs on it. The other thing that's important is each state determines if they're going to follow federal rules on that or their own. So like in my state of Colorado, we've officially decoupled from the feds, so we don't follow that rule anymore. So some of the deductions allowed at the federal level are not allowed at the state level. California, I'm going to pick on y'all again, sorry, but you only allow 50% depreciation regardless. And so some of my clients will get a killer refund on feds and owe a bunch to California. It's just how it goes, and you have to play the game as it relates to that. I want to address, though, the other entity types that I've mentioned and their purpose. So going back to my really horrible drawing about the different entity types. In a real estate investing strategy, say you own multiple properties and you want to help service them as a management company. A management company requires time and effort, right? And so you might be subject to those higher tax rates, as I've mentioned. So what you could do is you can create management companies as an S Corp and a C Corp and have them offer services to your partnership. It becomes a deduction on your partnership income to these entities, but then you have payroll, Jesse, to your point, as a deduction, reducing the tax exposure on those entities. So going back to my awesome little diagram here, I probably should have made more than one slide for this, so I apologize. It's really messy. Let me see if I can erase more of this damage. Oh yeah. I need to get better at this, so I apologize. Y'all are learning the very technical capabilities of my drawing skills, but all right, good enough. But what you could do is you could have this could be your management company. This could be an S Corp. It could then provide services to this rental. The rental gets deducted as an expense for the management company, and it's getting depreciation, making this even more losses. So this is tax-free money at this point, essentially. Then here, because it's an S Corp, you have to pay what we call reasonable compensation, meaning you have to pay yourself what you would have paid somebody else to fulfill the role. If you don't have enough income to cover that amount, you would then want to be reasonable around it, meaning if your profitability of that company is 100,000, but you would normally pay somebody 102, well, then pay somebody, pay yourself 80,000 or whatever. You don't want to run it completely dry. But so say you make 100K here, you pay yourself payroll. You now are only taxed on the 20,000. Yeah, it's taxable, but it's a lower tax rate because it's only subject to your regular income tax and not that 15.3%. So you've eliminated that as a strategy, but you've made this more of a loss. And if you are a real estate professional, meaning you meet the qualifications, and that's another class for another day, those losses, if you do this same strategy over here on the active income side, those losses can then offset this, making you not have to pay a dime in tax.
Real estate professional is so coveted, but it's a high bar to meet. And so it's definitely something everyone's like, oh, that's interesting. But certainly consult your tax advisor for what you need to do in order to do that. Or maybe Kelly, you can kind of give a few tips on that too, because I know people may say, "Hey, how do I use that magic of being a real estate professional?" And I know you alluded to a couple of things earlier before, but I think it's worth the reminder for people so that they can truly know how they can do that. What are some tips that they should have in talking with their own CPA about how they can maybe have that proof, if you will.
Yes. Okay. Thank you. Yes. Real estate professional status is the coveted status for the real estate investor, right? Because real estate professional status means all of your real estate holdings move into that active bucket, which means all the losses you create from real estate can offset any other income source. So say your spouse goes and works at a W-2 job, but you're the real estate investor, you can offset their income with your losses. And again, remember, real estate, when I'm talking about losses, I'm not talking about cash flow losses. I'm talking about tax losses. They're very different because the whole thing with real estate investing, you don't want to go buy a losing property. That is not what I'm saying. You want to buy a cash flow positive real estate investment with a tax negative consequence because of the depreciation and other costs or other items that you affiliate with it. Okay. But with real estate professional status, you have to be very careful. It's one of the highest audited items on a tax return in the tax code, aside from meals and entertainment and travel costs. And real estate professional status, you have to meet hours tests, and you have to meet the material participation, total hours tests, as well as the rule as it relates to the primary source of income. Okay, that's the most English way I can say this, and I apologize. It's a pretty lengthy conversation, but you can't. So for an example, Chris, are you okay if I pick on you for a minute, just as an example? Okay, so say Chris, he works a W-2 job, but he also invests in real estate. Weird, it's kind of like he does that right now, right? All right, anyway, so say he does that. He would have a really hard time proving to the IRS he is a real estate professional unless his day job is in real estate, okay? He would have to prove 750 hours or more, and majority of his time is created in real estate. That's what he does for a living, okay? And now real estate can look a couple different ways. It could be, you could be a real estate agent. You can just be the property manager and manage your real estate. It could be a full-time real estate investor. I have clients that are land dealers that deal in like land, and they're a lending officer. You can be a construction company and do this. However, you have to also prove that you materially participate and or provide the primary services for that real estate, as well as the other sources of income don't exceed this real estate activity. Okay. And there's a whole list of attestation rules as it relates to that. One of my favorite podcasts, and again, I've never even worked with them, but I love their podcast. It's called The Real Estate CPAs. They have a 4-section series on real estate professional status and what it means. And they do a great job talking in English, but they also prompt you with questions to ask your accountant. And one thing you'll learn about me is I'm always learning from other accountants as well. I mean, I love real estate, so I'm constantly studying it, but I'm also not afraid to say, like, listen to this podcast because I can't say it better than they say it. This is one of those podcasts y'all should be following as a real estate investor. They're called the Real Estate CPAs. And they also have one on short-term, a whole thing on short-term rentals and whatnot. But you need to be asking your accountant, is my entity set up correctly? Is there a better way to structure this to help save me money? Is my property cash flowing positively? And the thing is, if they can't really answer those questions, it might be a good conversation to have about looking for another CPA. And I hate to say that, but like I said, I have clients that ask me questions about estate planning and stuff, and I will bring in my estate planning CPA friend because I know that is my limitation. That doesn't mean as a CPA we go out the door. It just means we might bring in a partner for that particular scenario. Like for an example, I don't do cost segregation studies, but I have another CPA that we deploy them to do a cost seg study for my team, my clients, because that's all they do. And you want people that have this specialty to help you on that front. So I want to caution you that you've heard some great strategies tonight, but at the same time, you don't want to just go run out and do them. My favorite, I'm going to joke about this. I'm going to say this very off the cuff. One of my favorite clients is the client that comes to me that set up their own entity on what's it called, LegalZoom, and they self moved over their real estate into this entity, and then they're like, why do I owe so much in tax? And I have to tell them that by the way. In order to unravel this, you're going to take a tax hit in order to do it. Spend the time up front to make sure your entities are correct and you're holding your real estate, because there's a difference of if you open an LLC later to move your real estate into, should you quit claim deed, warranty deed, there's actual conversations that have to happen around the type of deeding you do in properties, because every single one of those things has a tax impact. And what happens is they'll talk to the attorney side, and the attorney will say one thing because they're trying to protect your assets. That's their job as an attorney, but they don't know tax. You know, there's very few tax attorneys in the United States, to be honest. Most of them are attorneys and tax accountants. Very few are combined. And so you want to make sure you're getting the partners to work together and not contradicting each other. That was a lot. I want to give question time.
There is a question in the chat that I can read out to you from Jesse, and it says, if I created an LLC, but I added several people as organizers, would that be considered a partnership or a sole proprietorship or LLC?
When you say organizers, Jesse, are you talking members? Do they have equity ownership interests?
Hi, when I say organizer, mean like when I filed the LLC on the state website and pay for the annual registration thing. So let's say if I added like 2 more people in it as the organizers, but I still stay as the registered agent and member and also the organizer.
Yeah, so
Then would that be considered partnership with the other 2 people, or single or member as in my operating agreement? Because I know that I can still update, like edit my operating agreement, right, to include more people or remove people. But then I don't know, like in that case, like if I already added several people as organizer in the state document when I filed a company, then would that be considered partnership or single member LLC?
Oh, you asked a really good question. I love this one. Okay. You're going to love my answer. It depends. So let's talk about that. Political answer, right? So let's go there though, because it's a really good question. So say you initially register your LLC and it's just you, but then you go on your state website and you add another member. I want to be very clear, member, not organizer. You add another member. You would want to update your operating agreement to reflect that you've added another member and adjust how they bought in. So if it's somebody that's buying into ownership of the company, whether they're just giving you capital investment, such as equity investment to go spend money. So if you, we've talked a little bit about syndications tonight. So say you give somebody money to go invest in real estate, you're essentially a partner in a syndication. If you've put an investment in, then it becomes a partnership by default. But here's the fun part. The state doesn't tell the IRS you did that. You have to tell the IRS you did that. So if that organizer, because each state Secretary of State's website calls it organizer, member, registered, like they have a million names for everything. If you have to tell the IRS, I added another person. If you go from a single member to a partnership, or you want to add somebody, you actually need to file an entity change form so that way you can keep the EIN. Because if not, you'll have to get a new EIN number and open up a new loan, new bank account. It gets really ugly, especially in real estate, and especially if you're talking about titling of companies. So you're going to want to make sure you file the entity change request with the IRS saying I'm now taxed as a partnership and have it indicated as such. You can have organizers or other players involved in your entity, but they're not be equity owners. So for an example, in JFS, Bonnie on my team has moved into being our director of divisions. She's not an equity partner. I refer to her as a partner though. She will be an equity partner next year. So next year, JFS will become an S Corp with a multiple members. We're S Corp because we're active trader business. Remember, I wanted to save on that 15.3%. And so you would add that other member. But again, if you add a member, you need to tell the IRS that you are a partnership. Once you're a partnership, though, the only way you tell people, the IRS, that you have more partners is by updating the partnership capital structure on that return. You don't need to file an entity change every time. The hard part, and I want to be very clear about though, is if you're a partnership and a partner goes away, there used to be this thing called a technical termination. If a partner goes away, you terminate the partnership and you have to get a new EIN. That is not the case. However, you do need to tell the IRS you're no longer a partnership and that you're a sole proprietor again, LLC. And it's called an entity change form, and you have to give a reason as to why, and you have to show that in the return. Great example, as I had a client, their spouse passed away. They were a real estate holding company together. The partnership would have ended, but the real estate was still held, and it automatically went to her as the main owner of the estate of the house. The estate transferred it automatically to her. As a result, we filed a change of entity form because she didn't sell the real estate on that front. Okay, so moving back and forth is really interesting as it relates to entities. If y'all remember my diagram and I drew the LLC as an umbrella, it's easy to move up under the umbrella. It's really hard to move back under the umbrella. So that you just have to file the appropriate forms. That's a great loaded question, Jesse. Good question.
Yeah.
Okay. So it sounds like I will need to contact the IRS first and see if I can like change, let's say change from single to partner or change from partner to single.
Yeah, so
Right.
depending, if you're adding members and you're going to a partnership, I wouldn't contact them because good luck getting a hold of a human being there. But you would file the form. There's a form you file that's called an entity change of classification form.
And it's on the IRS website.
It's a great question. I normally file them electronically through my yes. I would say, I mean, they're all on there. So yeah, I would say so. If you're going to mail any paperwork into the IRS, I don't care who you are, certify mail that puppy and track it like a mother goose. And I forgive my phrasing, but if you haven't looked at any pictures about the IRS online, they're so full of backlogged paper that they often lose it. So you're going to want to be very clear about how you transmit that information. Usually what you do is you file that entity change request form with the tax return. So that way it doesn't get lost and it's done electronically. But your CPA should be able to really help you on that front.
Okay, so it's just file it when I file the tax return with this year.
It's really hard for me to give you that advice without knowing the whole scenario and looking at all your operating agreements and stuff. So that is definitely something I would bring up with your CPA specifically.
Okay.
Great
Yeah, I'm
question,
looking for
Jesse.
one too. I'm looking for a good CPA too.
Yeah.
Well, what I'll do for you, Jesse, and is when we distribute out this recording, we'll also include Kelly's contact information to reach out to her as well. And I know before we close this evening, Kelly can tell you how you can reach out to her firm for information as you're in this exploration phase. So certainly stay tuned for that. But great question. How about anyone else have any specific questions or general questions for Kelly before we wrap things up? And I have a few questions to ask Kelly that I ask all of the presenters on this meetup.
I want to preface real quickly before you go into your questions that I scratched the surface of a lot of topics tonight. Here's the thing about taxes and real estate. Like, my recommendation is you can't study this enough. This is what makes Chris and Allie such great clients of mine is they come to me, hey, I read this article. Hey, I saw this. Hey, I did that. Because they're constantly educating themselves on it. I know a lot of really good CPAs that have a heart of gold, but unless I know you're interested in that topic, I don't know what advice to give you, right? And so you as the taxpayer and investor have to become educated enough to know what questions to ask. And I hate to put that responsibility on you because you would think it would be like common knowledge that your CPA would be able to give you tax advice, but my definition of tax advice compared to some other CPAs might not be the same, right? And so help us help you by asking those questions. There's some great books out there like Tax-Free Wealth, the Real Estate CPA podcast. Like I could go on a list, and maybe Chris, I'll give you a resource list because I keep typing them up as I go. But and I've shared a lot with Chris. He could probably share some of the notes that he has too. But the whole thing is, you as the taxpayer have to take the time to get educated. And I'm sorry to say it, I know it's not your profession, but that's why real estate is such a great investment. Is there's so many great tax saving strategies. And so you at least need to know what questions to ask so we can help drive your education deeper. I think, Richard, you came off mute, and did you have a question? Okay,
No,
maybe
it's
not.
all right.
Oh, no, you're good. I just wanted to make sure I didn't have anything burn in there.
No, Kelly, great points. Before I jump into the questions, would you like to tell people how they can get in contact with you?
Yeah, of course. I actually, not my ugly drawing. There's my contact information for y'all. So the best way is to email this info because my inbox gets a little fun. So Nadine in our office actually helps me facilitate discovery calls and conversations. And if we're not a good fit for you, this is one thing you'll learn about me, I will help you find a good fit. Because I'm not everybody's cup of tea. Like, this is how it is. But I do know some killer real estate CPAs as well. So like if we aren't the fit, I can help you find one. So don't hesitate to reach out. If you don't have a CPA resource, I will find one if it's not us. I want to be very clear about that. Because to me, taxes is not something we mess around with. Like, we want to be very, very specific about it. And you want to find that right partner. And through some of my accounting networks, I've created a really great group of CPAs with all different personalities and focuses that could support you in that.
So take a screenshot of that. Of course, yeah, I will email out, when I email out the recording, I will also email out Kelly's contact information and maybe that helpful list of resources that people can access and just to help aid their education in this space. I think those will be some useful things that we can pass along. But yeah, this has been great. Anything else, Kelly, before, or questions from the group, or Kelly, anything else that you'd like to share before I jump into the questions that I ask everyone?
No, other than thank you, Chris, for letting me share this with everybody. I hope it helps.
Absolutely. This is just a wealth. I've learned something new every single time. It doesn't matter how many times we connect. But let me start with this. So these are questions that I ask, everyone, every expert speaker that comes on to this meetup. And I think it's great to learn and to know. So the first question that I ask, or that I like to ask, is, what does financial freedom mean to you?
Oh, good question. Financial freedom means to me that I have the ability to leave the legacy that I'm striving for. My purpose in life is to teach and grow our youth in financial education. I think it's a huge gap. So financial freedom to me gives me the resources and ability to be able to make that exponential. And so I've created a nonprofit called the Free Foundation, which is the foundation for teaching economics and education to our youth. And I go in and I teach 8th graders and 9th graders about how to invest in real estate and save wealth. And my goal is, I want these youth to come out of high school knowing how to manage their money. And that's what financial freedom is. It's this ability to carry out that purpose and leave behind a legacy for somebody else to carry it on well beyond my years.
That's awesome. And it makes me think about, man, I wish I knew all this stuff when I was much younger and I could be applying it. But, we're here now, and you're helping to educate people now. And definitely that is such a noble cause. And the next one is also a good one, you might think, and that's about, the travel. I love to travel. And I always think it's great for people to get to know how other people like to travel and spend their time. You live out in Grand Junction, Colorado, but what is one of the best trips that you've taken, and why?
Oh, that is a good ringer. So full disclosure, I don't travel very often because I live on a ranch and I have cows and horses and chickens and old McDonald's farm. So I have to find somebody to take care of them while I'm gone. But I do travel a little bit for work with my husband's support because he's freaking awesome that way. And I want to say that my favorite trip was one where we both were able to sneak away. We were able to go to Maui. I too love beach and water. I mean, I live in snow, but I really love, I could sit on a beach all day. And I think the reason being was it was unplugged quality time. To me, again, going back to that financial freedom question, being present is so important for me when I am off of work, because I work a lot. If you don't know that about me, I work all the time. But when I do unplug, I unplug. And so like spending quality time, like we spent days just sitting on the beach reading paper books. Like it was great. And having that quality time around each other is super important. I don't have children, but I do get to spend time with family. And I think that trip, it was 3 years ago now, was probably one of my favorite because we were literally unplugged for 7 days together. It was great.
I added that to my bucket list. Need to get there for sure. Great. That's great. You're working, you're building a business. What are some of the things that you're working on these days that like at JFS that's like, this is something for 2023 we really want to accomplish? What have you told your team? What are you working on these days?
Well, that's you're asking some good ringers, man. No, just kidding. One of the things I'm really excited for 2023 is I want to duplicate the ability for me to reach more people. So I'm a very big tax nerd. I mean, I read tax code for fun. But again, I'm always trying to figure out why it works for some people. And my goal is with my team to instill the confidence for them to be able to teach the same things I teach to our clients. Because right now, Michael on my team is so strong. And so really helping grow him and grow Chris and grow Bonnie and my whole team to be able to do what I do. So it's not all centric around me. I think will allow for us to reach and impact more people. Because how I see JFS as a killer vehicle to help people build wealth. I don't classify myself as an accountant or CPA anymore. I'm a wealth building machine is my goal. And what that means is I want to instill that in my team and have them see that value. So when I look at 2023, I spent the first, all of December and the first 3 weeks of January, we've literally designed our procedures and processes to help them get the knowledge base that I have, as well as communications training on how to speak English in the accounting sector to our clients in a better format. Because most of us accountants speak tax code and that doesn't always translate in the message. So that is, I think, our biggest goal is to be able to expand their base, to be able to help our clients deeper. My goal is, as far as the company is concerned, I mean, I have some revenue projections and whatnot, but I'm not looking to add a whole bunch of clients. I want to go deeper with my clients. I want to be able to do more one-on-one coaching and consulting and be that partner, that invisible board of directors member, and not be like a mass market tax shop, essentially.
Yeah. Oh, that's awesome. They say, it's not, when, in order to grow your business or to really help your business thrive, you can't be working in it. You should be working on it. And by getting these personnel that you have within your team, up to your level in terms of the consultation and guidance and advice that they're providing your clients, it certainly gives you the ability to work more on the business instead of in the business so much. So I think that's awesome goal. The last question, Kelly, for you, and then we'll wrap it up for the evening. Is the name of this meetup is Wealth Mindset, and of course we talked a lot about real estate investing, but I always like to ask folks, what does having a wealth mindset mean to you?
Wealth mindset to me is not looking at money as a crutch and or a lot of people just hold on to it, right? To me, a wealth mindset is looking at everything we do as an exchange of energy and currency, energetic currency. And so by understanding that money is just numbers on paper and a mechanism of getting you from A to B, you can really shift what it looks like and what wealth means to you. So for me, wealth is having time available to me. Wealth is having the ability to say yes or no to ideal clients and non-ideal clients because I want to work with cool people. And, wealth means to me having a purpose to be able to educate you because I just love seeing them light up. To me, it's not about always the financial piece. Financials just allows me to have the resources to do it. And so if I look at it more as a mechanism to do it, wealth can be created really quickly. Right now, I'm going to give you a great example. I've gotten the opportunity over the last month I want to say 3 months, save a hospital from going under. They almost didn't make payroll. We'll just put it that way. And as a result of putting together numbers on paper and coming up with a strategy, we were able to save the hospital and not lay people off during Christmas. And so, and I know that seems kind of a weird way of putting it, but that's a wealth mindset to me. I still haven't been paid for them, but you know how many jobs I saved? I saved 76 jobs, and they all got their Christmas bonus. I'll get paid next week. I'm okay with that. But that's wealth, is having the ability to be able to say, I'm going to help that organization or those people, and looking at it from a bigger picture.
That's awesome, Kelly. Congratulations on that. What an awesome story, and what an awesome way to end it. I'm going to just say thank you so much for spending time with us this evening, and the extra time with us as well. That just a wealth of knowledge that you were able to share with everyone. Again, for those people that are interested, that I know you posted your contact information earlier. We'll go ahead and circulate that for everyone. For those people who weren't able to attend live, they will be able to see it in the recording, and I'll also include it in the email that goes out to the entire distribution list. So thank you all for coming this evening. If that is it, we'll go ahead and shut this down. And again, just thank you all very much, and have a great evening.